All right, where we are. Okay, everybody. So this is episode 13, right?
14.
14 of the physics of Bitcoin, and we are 3/19, 2025. We had a very nice rally today. Not rally, but at least green candle. It feels like a rally after so many red days and Bitcoin not doing much. So it's a pretty good thing. And, we will try to make sense of this. This is, by the way, the physics of Bitcoin. And I always spend a couple of minutes to introduce the nature of a show because we have been doing this for a while, but, it could be new people. So they are wondering, what is this physics of Bitcoin? But basically, the idea is that both Hai and Stephen have a PhD in physics, in particular astrophysics, and you may wonder what physics or astrophysics has anything to do with Bitcoin. But the point is that physicists have started to study the world in many different areas that are not necessarily the natural world. And in particular, we have a lot of physicists in Wall Street analyzing market, trying to use tools that we have developed for physics to maybe predict the market or try to have some understanding of how things happen. But with Bitcoin in particular, right, we believe that there are a lot of patterns and a lot of behaviors that are actually pretty, they fall into this range of things that actually physics can study. So we are trying to use this type of tools that one could apply to other physical system to Bitcoin, and with some degree of success. So we are trying to make sense of it using these tools and our experience of looking at the data over many decades in many different fields. So that is the gist of the show. This is what we are trying to do in this show. Okay. And as always, you can also comment if you feel you want to add something.
Thanks everybody for joining. We'll get into why physics in my presentation.
Good. Okay, so I need to charge my phone. So I will let Stephen take over, and then after he's finished, I will make my own presentation. So please, Stephen, go ahead and show your slides.
Okay. Can you see that?
Yep. Yes, very
Great.
clear.
Okay. So we've now had 14 sessions, or this is our 14th session for physics of Bitcoin. Last week, I talked about higher moment analysis for Bitcoin, and I'm going to extend that discussion today. And I'm going to look at it in a multi-asset framework where you're trying to optimize a portfolio of 3 or 4 assets. So here's the agenda around the higher moments. The particular ones that we're most interested in are the 3rd and 4th moment, which are known as skew and kurtosis. People have probably heard of Sharpe ratios and Sharpe analysis. There's a more general category for that, which is Markowitz mean variance portfolio optimization. And that looks, as the name says, at the mean and the variance. So the mean is the long-term trend. The variance, is the volatility. Standard deviation is the square root of the variance. And typically these assets have exponential behavior, compound annual growth kind of behavior. So that's what the mean is usually finding when you do that kind of analysis. Now, we know that distributions in financial assets, and it's certainly very true for Bitcoin, are not symmetric. And in our case, we have positive skew. We have these big, fat right tails. We see them in the bubbles particularly. And there's also kurtosis characteristics, which is more about the width relative to a Gaussian. It could be narrower, it could be wider. Now, as I discussed last week, if you're going to do this analysis for Bitcoin, it's very important to understand that it's a power law asset, and to detrend the Bitcoin with the power law in order to get the residuals that you then feed into the analysis and the optimization. And when we talk about MicroStrategy master, we can do that as well. We can detrend it with the power law. It does have this power law sort of behavior as far as we can tell. If you do that, you find that the higher order moments are much smaller than you get with the conventional technique of just looking at the daily ratios. Typically what happens is they look at the price today relative to the price yesterday, they take the ratio, and then they take the log of that. And that's how they do both the standard sort of Sharpe and Markowitz mean variance analysis, and also how they do the analysis when they add in skew and kurtosis. So that's what I'm going to present, is that kind of analysis, but with the detrending, with the power law for Bitcoin, and in the case where I show MicroStrategy, for MicroStrategy as well. So we'll start out with 3 assets, Bitcoin together with SPY and gold. And the goal is to see what's the optimal portfolio mix. And there's no really clear answer here. It depends on how much you weight the skew and kurtosis, but you'll get a range, and we'll give you a feeling about that. Then I look at just 2 assets, Bitcoin and MicroStrategy. I talked about that last week. It was a somewhat simpler analysis. This goes into more detail with a longer data series for the skew and kurtosis, but the same 4.5 years with respect to MicroStrategy, because that's when it shifted to the Bitcoin strategy. And then finally, I end with a 4-asset portfolio that includes Bitcoin, the stock market in the form of the SPY ETF, gold in the form of the GLD ETF, and MicroStrategy. Okay, so just to kind of set this up, why do we want to do this? Why are we doing all this? In the last few weeks, I've talked about structure function analysis. We've talked about scaling functional analysis, which feeds into the Hurst exponent, which shows you how strong a trend is, how persistent it is. We looked a little bit about the multifractal nature. And now we've been doing, since last week and now this week, the higher order moment analysis with the skew and the kurtosis to look at tail risk and the width of the distribution. And I saw a couple of papers and I showed them last week. One from a gentleman named Zhu and the other from a gentleman named Zhu, spelled differently. And they both did something similar, which is they looked at skew and they looked at kurtosis, and then they kind of threw them away and settled back on Sharpe ratios in order to determine Bitcoin fractions. They also had pretty short windows that they measured in. But most importantly, they don't know about the power law. They didn't do power law modeling. So all the residuals are done in that conventional way of taking the daily differences, taking the natural log of that ratio. So I fed this question, these studies are not sophisticated in my view. What do you think, ChatGPT? And it said a serious Bitcoin investment analysis should incorporate power law modeling, higher order moment analysis, as we're doing here, Hurst exponent studies, as we've done in previous presentations, regime shift detection, which we've done with Markov analysis, and by showing that there are basically these strong bubble zones, strong core power law zones, and then transition zones. So I've shown some of that work. Actually, the residuals are bimodal. And so that's another way you do regime shift detection. And then comparing with other, it says exponential. It's using it in the sort of vernacular way, because we know that the internet adoption had power law characteristics as well. It adheres to Metcalfe's law that applies in the case of Bitcoin, but they mean rapidly growing adoption curves, or compare to gold. We've done that as the other sort of ultimate asset. So we want to know about the why, and that's why we use these other techniques and other modeling methods, other mathematical techniques. You know, just doing the how is statistics, but if you ask why, you're getting into the physics of things. Now, Chat then went on to say most finance researchers lack the mathematical tools to analyze Bitcoin properly. Well, I disagree. I think they get it wrong here, because finance researchers know how to take squares and cubes of numbers. They know how to take logarithms. They know how to run regressions. So they have the basic tools. But what they don't have is the mental models, the mental framework, or the flexibility to analyze, and the understanding that we've got an asset that doesn't behave like all the other financial assets that they're looking at. So their conclusion is the paper is just another generic risk return study that doesn't get to the core of why Bitcoin is structurally different. So that's the why for why we're doing all of this. Now, in terms of portfolio,
And sorry to interrupt you here,
so
because
their conclusion is the paper is just another generic risk return study that doesn't get to the core of why Bitcoin is structurally different.
there is a
So
delay.
that's the why for why
Do you hear me? Because
yes, I hear the delay. Of portfolio,
It's going to interrupt you. Yes,
so their conclusion is.
do you hear me? Sorry.
Yes, I hear you.
I was listening you on the phone, and somehow there is a delay. It's weird enough. You were continue to talk on my phone, but so what I wanted to say, because this is such a beautiful point that you made. Sorry if I interrupt you. I want to make a comment on this. That is what I'm trying to explain so many times to everybody. Okay, and there's no ego, is no megalomania. It really is difficult to communicate. It's one of these things where there is a reason why people like me and Stephen went to physics, because it's really a worldview. It's a particular way of seeing the universe, right? And this is why physics has been successful when applied to many other fields. Like, for example, when I went to neuroscience, within very short amount of time, I had a patent in the field, because to me, a lot of this low-hanging fruit that I could catch by using my way of thinking, my way of seeing, my eyes of a physicist, allow me to have breakthroughs that all the other people that knew maybe the brain much better than me, and they were medical doctor and many of the years of experience, didn't have. So Stephen is completely right here. Even if people are aware of what a log is, and not everybody know, but it's a relatively simple concept. The fact of realizing the relevance of it and how to apply what it means, etc., is something that, I'm sorry, basically only a physicist can do. And there is a reason why physicists discover the power law first. There's so many other people could have taken this. This is one of the things that it really upset me a little bit, right? And I am Italian, I have a passion, but when they say, oh, you just took a log and log, it's just a straight line. No, because it takes a completely different way of thinking to try to find this particular pattern. And once you find it, understanding the relevance, and that is what physics give us. This is why it's so important to have a physics angle in trying to look at Bitcoin. Okay, this is the end of my comment, but hopefully it was, people understand what we are trying to communicate here. It's a different angle. It's a different way of thinking about stuff that physics gives you.
Yeah, thank you for that, Gio. Thank you. So the next thing is about portfolios. And here, a lot of people want to focus on market timing. Oh, when will the peak be with this cycle? Is it going to be in September? Is it going to be in November, December? And people focus too much on market timing in general. And you look at the richest, most successful people, whether it be Warren Buffett, who does not understand Bitcoin, but he understands stocks. He's about optimizing his portfolio and holding for a long time. Michael Saylor is the same way. He's about accumulating as much Bitcoin as he can, holding it as long as he can, buying at new highs and figuring out new ways to raise capital, through different channels, which he's just introduced another one. So he's about time in the market as well, rather than market timing. So I don't care whether you want to think about Buffett or Saylor at this point, they both support this concept. And what that says is that you want to optimize your portfolio in terms of how much Bitcoin you hold. And, you may hold other assets. How much would you hold there? You want to hodl, but then you can rebalance in order to remain near the optimal allocation. And this is not to say you shouldn't, go buy options and have fun on the side, but this is for the bulk of your portfolio. Optimize, hodl, and then rebalance to keep it at some sort of close to optimal distribution of the assets. If you ask chat, it says portfolio optimization is crucial for consistent returns and that asset allocation explains over 90% of performance. Picking the best asset class is the most important thing for any given decade. Well, we know what the best asset class was for the decade of the 2010s, and we believe we know what the best asset class certainly is so far for the decade of the 2020s. But then you add risk management, you add optimization, you're less emotion driven, you remove the guesswork, and you get to take more advantage of compounding. Now, let's get into the meat of it. I showed this slide last time, but this is just to remind people who were on the last call or to set things up for people who are just joining us this week, but not last week. This is the core equation of the analysis of the higher moments, of the various moments. So a moment, S sub Q, is equal to a series of returns raised to the Q power. If it's Q equal to 1, then it's really the mean return. If it's Q of 2, it's the variance. If it's Q of 3, it's the skewness. If it's Q equal to 4, it's called the kurtosis. And the 5th and 6th moments are called hyperskew and hyperkurtosis. And what you want to do is take all of those, say, daily returns or whatever your interval is, raise them to the Q power, and then take the mean across the distribution. And then it's convenient to normalize that by the Qth power of the standard deviation. Now, if you do that in the traditional way, just taking the daily price differences and then taking the log of that ratio, then what you see is in the white box for Bitcoin. And it shows for Q of 2, 3, 4, 5, and 6, the normalized moments. Well, the variance, that's sigma squared. That's the standard deviation squared. So once you normalize it, it's 1 by definition. And then 3.8 would be the third moment, the skew, and 25 would correspond to the kurtosis. And then the higher moments, you see they're quite large numbers if you do it the traditional way. But in the black box, what I've done is I've first detrended by the power law. So I run a power law fit. I use the median in a quantile regression. You could do it with ordinary least squares. It wouldn't make much difference. But it's a 5.87 power law of time, which you see in the log equation. Log price at 5.87 times the log of time. The R squared is 0.95. Now look at what the skewness value is. It's 1.94 instead of 3.8. It's been cut in half. The kurtosis is 5 instead of 25. It's like the square root. It's much, much smaller. And so the histogram shows for the 2nd, 3rd through 6th moments, shows the raw approach without power law detrending. And the orange, darker color, shows what you get with power law detrending. So basically what this says is you have much better behavior, if you will. It's less volatile in some sense once you've realized that it's got a power law running through it, and then use that to determine the residuals. Okay, so that's sort of the basis of how we do. And then what we do is we feed the mean and the residual in terms of the variance of the residuals, and then the higher moments, the skew and kurtosis, we feed into an optimization algorithm. And I'll show you the equation of that for a moment, but it's looking to get the optimal portfolio allocation depending on the growth rate, the variance, and those third and fourth moments, the skew and the kurtosis. Now, in the case of Bitcoin, we know from the power law what its mean growth is. And so I actually calculate that from the power law. And right now it's 42% per year based on the 5.87 exponent. And in this case, for the variance, I've used 8 years of daily data. And in the comparison to the other assets, the SPY and the gold, I've used 8 years of daily data. I don't want to use the whole price history because Bitcoin's variance has been coming down. And so we want to get a better measure of that. Now, this is what happens before you do the power law detrending of Bitcoin. And what happens is you tend to get a lot of gold in the portfolio, but it depends on how much weight you give to the skew and the kurtosis. And these lambda and beta terms, those are respectively the weight for skew with lambda and the weight to the kurtosis term with beta. And then I show for each of the 5 columns, I show 1, 1, 0.5. That's the values of lambda and beta for that particular case. And you see it can move around a lot. Bitcoin does better if you underweight skew and underweight kurtosis with this traditional method that doesn't have the power law detrending with Bitcoin. And you might get 40 to 50% allocation in that case. And in some cases, it says put everything into gold, nothing into SPY. But in the cases where it says up to half Bitcoin, it kind of divides the rest between stocks and gold. Again, that's before power law detrending. Now, things change considerably once you detrend with the power law, and now Bitcoin dominates. And more so with higher weights on the skew and their kurtosis. So actually, to clarify, because I misspoke a bit, in the last slide, I used the return calculated from the traditional method. In this case, because I'm power law detrending, I used the 42% projected annual return from the power law, and I used the historical variance, which is about 0.237 in log 10 terms. That's about 72%. Now we have a lower skew and we have a favorable negative kurtosis in this case, and it ends up allocating 50 to 75% to Bitcoin, and then the next largest amount, around 25%, gets allocated to gold. And for stocks, it allocates between 0 and 25%, depending, again, on the weights that you pick for lambda and beta, for the skew and kurtosis, one being kind of a neutral posture. Now, I ran more than 5 cases, and I show in the next slide a little more clearly the visualization of those. And this shows the skew parameter lambda on the y-axis. It shows the kurtosis parameter beta on the x-axis. There are 8 different cases that I ran. And you find that Bitcoin dominates more so with higher weights on the skew and the kurtosis. If you take the neutral value, it's 58%. But if lambda and beta are above 1, then that number increases. And so you get as high as 80% with this various set. It becomes a judgment. You can't really say that this weighting is correct and that weighting is better. But to the extent that you feel comfortable weighting more by the fact that Bitcoin has superior skew, higher lambda, or superior kurtosis, you can allocate more Bitcoin to the portfolio. So I just want to let people absorb that for a bit. That's kind of a range, 60 to 80%. All right, in the next slide, I looked at, for two assets, comparing Bitcoin and MicroStrategy, just a two-asset portfolio. And the first thing you need to do is run a power law through the MicroStrategy data. This is the daily data from August 11th, 2020, which is the day when they announced the Bitcoin strategy for their treasury. And the power law fit is a 7.3 exponent, a 7.29 slope, or power law function of time. You need to base it on the Bitcoin age, because what they're doing is, it's like they're hopping on the sandworm. Bitcoin's the sandworm. They've hopped on the sandworm. They're riding it. And so it's really, a derivative of Bitcoin behavior, or really an accelerator on Bitcoin behavior. The R squared is not that high. It's a very volatile asset master. So the R squared is about 0.42. The skew, though, is slightly positive, and the kurtosis is less than 3. It's about 2, and 3 is a Gaussian case, so it's got a narrow kurtosis. Kind of interesting. Now these are detrended, power law detrended values for those higher moments. Okay, so then if you use those and then you run through the optimization algorithm, and I'll show that equation to you here, then you get a utility function that looks like the graph. And so the utility function rises with the weight assigned to Bitcoin, and then it starts going down. And the optimal value for Bitcoin in this case is 61%, 0.61 weight to Bitcoin, if you turn off the skew and turn off the kurtosis. Sorry, correction. If you set them both equal to 1, if both the skew and the kurtosis is set to 1. If you turn them off and set them both to 0, then it's 64% Bitcoin and 36% master. And so what's going on is you have this equation, return minus these terms. And the first term is a term that looks like a Sharpe ratio. It's the portfolio return divided by the standard deviation minus a skew term, because positive skew to the right tail, which means the right tail is working for you, works the same way as higher return relative to standard deviation. But then the beta term has the opposite sign. That's the kurtosis term. Large kurtosis works against you. So positive skew is favored, and the fourth moment kurtosis is penalized. The optimizer favors assets with lower tail risks. So what you do is you minimize this equation. The utility is just the portion in gray. It's everything that's not the return. So you want to maximize that, but you minimize the total equation when you run the optimizer. So that's why this utility function is going up and then falling, and you're looking for the maximum. Now, this is a little bit different result than I showed you before, which was 100% Bitcoin. And the reason for that is I have more data here. This is 8 years of Bitcoin data rather than 4.5. And now the final analysis that I did was a set of 4 assets. And in this case, we've got stocks with SPY, we've got Bitcoin, we've got gold, GLD, and we've got master all together. Both Bitcoin and master are power law detrended. 8 years of data for everything, but master just 4.5 years. And we find actually quite a broad range of outcomes. It's either all Bitcoin or gold is a majority. It's kind of bimodal that way. It's almost like it's saying, well, I want the safe, pure asset, or I want the riskier, pure asset. If the skew weight is larger than 1, then it flips to fully Bitcoin, 100% Bitcoin. And the master allocations are always small. And if gold has a big allocation, the Bitcoin allocation is small too. So it's a very complex surface. This is a higher dimensionality surface. It's got very complex behavior, and you can find these local minima, within such a complex function. So how do we interpret this? In general, what we say is that and these are the interpretations right out of chat, but I agree with all of these. If you have high lambda, which is weighting skew, and if beta is moderately high, then the portfolio concentrates entirely on Bitcoin. Bitcoin's high positive skew of 2.5 is being favored. And it doesn't matter that the kurtosis is negative, the high skew dominates. If you reduce the kurtosis parameter beta all the way to 0, you shift away from Bitcoin and you increase the weight in SPY and gold. If you reduce the parameter weighting for both skew and kurtosis, again, gold gains. And if you lower even further the kurtosis parameter, Bitcoin allocation shrinks down to 5%. The impact on master consistently receives minimal allocation here because of its higher volatility of over 100% volatility. So the takeaway here is lots of Bitcoin if you believe in the skew. That's kind of the most minimal takeaway from this. If you're willing to weight skew at 1 or better, then you can go very high on Bitcoin. If you take master out of it, it simplifies it a bit. And so if you do a 3-asset, 58 to 80% Bitcoin, and then gold is your number 2 asset, you have to power law detrend. If you don't do this, both the mean and the standard deviation are overestimated, and you end up drastically overestimating skew and kurtosis as well for Bitcoin. So Bitcoin for every moment. What we're really choosing between is 3 classes of assets: minted, mined, and printed. Well, what's minted? Bitcoin is minted. It's minted out of energy. And the minting process takes an enormous amount of, ASIC-driven cryptographic hashing at hundreds of exahashes. And that encapsulates it securely and puts the reeded edges around, and nobody can screw with it. So Bitcoin's minted. A master is minted to the extent that it's basically holding Bitcoin in its treasury. Gold is mined, and it increases about 2%, whereas Bitcoin less than 1% going to 0. That's per annum rate. And of course, SPY is printed. They can print more shares whenever they decide to, or whenever their board of directors decides to do that. And on average, for the SPY, it's about 4% more shares per year. I put a question mark next to gold. Sometimes people argue that the ETFs, maybe they're creating shares that they shouldn't be, that they're not fully backed by pure gold, although that's speculation. And it seems when they have audits that they pass their audits. Master, to some degree, is engaged in printing because they can create new equity shares, and they do sell new shares into the market in order to buy more Bitcoin. And they do create debt, of course, debt security vehicles and preferred shares, and they've recently introduced some of those into the market. So they're somewhat of a combination here. My argument is that the new 60-40 is Bitcoin with the 60. You might want to go higher, but as a rough idea, and then 40 for everything else. Consider what's minted, what's mined, what's printed. Consider what's absolutely capped and what is slow and what is fast in terms of issuance. Thanks for watching. And next week, I'm going to go into Kelly log wealth optimization criteria. It's another way of analyzing what assets you should have to what degree in your portfolio. And it can be entirely model free. In the classical case, it's just kind of taking all the returns in a model free way. Unlike what we've done here, which is we've fit model parameters, both in the power law and in the higher moments. But with Kelly, you don't do that. You do have to determine time frames, and it behaves differently on different time frames. So that's what we'll do next week. And thanks very much for listening.
Fantastic presentation, like always, Stephen. Thank you so much. Did you calculate maybe a P&L curve of this portfolio over the last 10 years or something, with different allocations and so on?
Yeah, I haven't, because the range of allocations was so wide.
Yeah, maybe
it
you
almost
can show a range, right?
But maybe for the typical case, it would be an interesting thing to do.
Yeah,
Maybe I'll do that next week, because I've already started doing that for the Kelly optimization criteria, showing
Okay.
equity curves. So I will do that for some of the like the lambda equals 1, beta equals 1. That's sort of the,
because one of the things I want
standard
to
optimization.
see, that I'm curious, is how it behaves, for example, during a bull run, during the bubbles. Does it find kind of a middle, where I want to see how correlated these things are, right? For example, why do we allocate at all anything from the other assets? I want to have some kind of intuitive understanding about
Yeah.
that. Does it help you with minimizing the the drawdowns when we have a bear market? What is the
Yeah.
usefulness of introducing anything else?
It's a hedge. Look, if you do a pure Bitcoin cash, and whether you say cash is 4% or earning nothing, because it almost doesn't matter, right?
Yeah.
And if you do a Kelly criterion analysis, and if you use longer time frames, you'll get like 70%. If you use a quarterly time frame, I forget, it's like 50-60%. If you use annual, it's like 70+%. So, the question is, why aren't you 100% in Bitcoin?
Yeah.
Well, if you use a 4-year time frame, every 4 years has been positive. So you would be 100%, right?
Correct.
And that's why we're sometimes seeing 100% in these analyses this week.
Yeah.
But if you say, well, I'm not sure I'm comfortable with 100%, I want to rebalance from time to time, maybe I'll look at things annually, then you get 70%. And what that says is, when you do have a big drawdown, you've got some cash available to buy at prices that are below the mean trend, right? I mean, you want to buy below mean and sell above, right?
Right.
Ideally, you'd like to sell at 2 or 3 times above, and more power to you if you do.
And
now, then your
sorry.
cash, what do you want to hold your cash in? Well, maybe you're better off in gold, right? Because gold is not as dirty as fiat.
Yes.
Fiat is doubles every decade. That's the best fiat. That's like US dollar and euro. The very best fiat doubles every decade. Gold, it goes up 1.8%, 2% a year. So it doesn't double for 36 years, roughly. It takes more than 3 decades for gold to double. So it works as a hedge against Bitcoin in that sense. And so it's not surprising that it showed it as the number 2 asset. We know stocks also perform about 10% roughly. Unfortunately, they have negative skew, which works against you, but they do outperform cash. So you might want to have those instead of cash. But you want to have some powder, right, to take advantage of low prices from time to time.
Yeah.
That's the philosophy.
And also, these portfolios don't include some kind of dynamic rebalancing. It's just a fix. You didn't try to optimize for dynamics, right?
No, they do, because you want to continually update those ratios. You want to look at those, quarterly or annually. You want to recalculate, and it will tell you, as the parameters have changed a little bit, then you want to change your ratios.
Rebalance. Okay. And did you come up with a time to rebalance? What is optimal? I'm just thinking to.
That's a great question for Kelly. So let's kind of defer that because we'll talk a lot about that next week with the Kelly optimization.
Okay, very good, very good. All right, because I want to, and eventually maybe we can create a spreadsheet, right, with that people can actually use. Maybe we can make it as a resource, where there is some kind of time frames that people can use to actually rebalance if they want to do that, their portfolio. Maybe that could be something that we can share with people. Okay, very good. So in my case, I'm going to share my slides. Share screen. Okay. All right, so I'm going to elaborate a little bit more on what I did last time. I'm still working in this direction of trying to find whatever we can learn from using some liquidity measure. My future work will include more complicated measure of liquidity, maybe including my main source. I don't have a lot of sources besides trading view, so I'm not sure if there are other publicly available resources beside trading view, but there are a few macroeconomic indicators. So one of the things I want to do is to redo this fitting, but now doing it in multi-dimensions, right, using all these different maybe the banks beside M2 and whatever, and then doing multi-regression, right, giving different weights to the different contributions. So that is something that I'm planning to do for the future. But right now I just look at M2, and I'm pretty satisfied. To get this nice correlation, I need to cut a little bit of the data, because otherwise you see some bending there. It still holds pretty well, even if you don't cut it at 2014. This is what I did. I started from 2014. But if I include a little bit, you will start to see bending here, and it deviates from a pure power law. But it looks very nice power law if you start with 2014. I'm still using, and then it's undeniable that there is a nice relationship between the two, right? And very high R square, right? Now maybe as high as the power law in time, where we go all the way to 95. It's one of the things that people don't realize, how difficult it is to go actually from, it looks close, right, 0.9 and 0.95, but actually it becomes more and more difficult as you come closer and closer to 1 to get to these R squares. And you can see even visually, because there is a bunch of scatters like this, and of course these deviations are associated with bubbles. Here probably I kind of draw, I have another graph where I drew a line through these bottoms, and kind of you can fit a line through there. It's almost like it identifies some kind of a bottom. So it makes sense, right, that also the liquidity bottoms up with the price during the cycles. And right now we are in this region, right? And I was curious mostly, in fact, you kind of suggested, right, is this uptick that we are seeing today, it's too little data, right? But it could be a coincidence. But is it due to a turning around of the liquidity? Because I don't have here a graph. I will have to switch to my indicators, my trading view indicators. But what happened, and many people are familiar, is that the liquidity recently is going up, right? And there is this main question of, is there some kind of delay between the liquidity and the price? And there are all kinds of suggestions. I don't find yet a way to identify what is the best delay, because the R squares are all very close to each other, right? So one way of doing it is try different delays and make a graph of R square, and then maybe choose the one that gives you the best R square. But I was not going anywhere with that because we were all very close. I couldn't choose a particular one.
Can I make a comment or two?
Yeah, of course.
Yeah. Michael Howell has his own global liquidity index, and his regression finds 9.7. So it's pretty close to your 9.4.
Right.
And his R squared is the same. It's 0.90.
Okay, cool.
So that's very good confirmation.
Yeah.
As far as comparing, to look for lag, he claims an 11-week, I believe.
11 weeks, yeah.
And I think one way you could look at that is look at the AIC.
Okay. Yeah, we'll try
criteria.
that.
Yeah.
I will try that. But in this case, I use 65 days, that is close to 10 weeks. And so if you do that, when you get a price model, this is how the price model looks like. I would like to see a better pattern, maybe because, it's difficult to say. Like in this case, the red curve is below the black one, right, during the bubble. You will expect maybe there is the opposite during a bottom where the red curve is above, but okay, here is above, but here is not above.
Yeah, I think you need to detrend them and then scale.
Detrend them and scale. Okay.
Yeah.
Detrend them.
Because we know that Bitcoin responds very strongly. So.
Okay, detrend it with a very common power law. Yeah. I will try that. So there is a lot to explore that, but it will be nice to have a nice model that ties the two. And then if you do that and zoom in, so it should be taken with a grain of salt, right? Because right now, it's overall, it's a decent model that gives kind of a sense of direction, etc. The goal will be to see better, right? What kind of a price will you expect given a change in liquidity, right? But yeah, probably you need to eliminate everything else that is not due to this relationship, and that so the trend them. But so take it with a grain of salt. But if we take whatever I did with this delay, and at the end, this is the same delay that I used the other time. I didn't select it. It could be a coincidence, but I didn't select it on purpose to align this uptick with the change. But yeah, so they don't exactly align, but we are pretty close, right? Within a few days. So the uptick here happen, and they don't have to be 1-to-1, but we are close enough where, in theory, one could associate this uptick in liquidity with this uptick in price, right? So this is the prediction. But I'm going to play better with this, and it will be cool to see if, first of all, if this uptick continues, right, will be really interesting. And then to say, okay, right, it's actually, they are connected with each other, right? And if a model is correct, then one could predict ahead the price, at least roughly. And again, if you take at face value what this model says, in 65 days we go to 97, so we go back to almost 100,000. So yeah, but I need to work more on, of course, it's up to a point because it's already amazing there is this kind of correlation, but you're right, I will have to detrend it and then find the best delay that explains this, because I start to be convinced that it's not coincidence. I don't think you get coincidence out of this. The only question is that I have, and I don't know if you have an idea of this, given the fact we are dealing with, most of the economy now is digitized, and we have a global economy. Markets are very dynamic, and they respond almost immediately, right, to news and other things. Why it looks like a very long decay, right? I mean, delay on the order of 2 months. Why an injection of and also because probably there is also some kind of additional delay due to when actually the money moved and when it is reported, right, officially. And so the real delay probably is even bigger because I will have expected the other way around, that actually the price was leading, and the liquidity was lagging, mostly because it's not reported. I imagine, right, because of that information needs to be gathered, and so. But how come it leads? And why it leads by so much? It seems like something that it doesn't fit well with how fast market responds to change, and the fact that we are digital and global. What do you think about that?
I don't have an answer off the top. It's a good question for Michael Howell if we ever had him on.
Yes, we can ask him to come to the show.
Deep in that stuff. And I've read his book, and I don't have an answer off the top. It may have been in his book and it escaped me.
Okay.
I think part of it actually is, I think reporting would cause a lag. People don't know today what the liquidity is. They know what the liquidity was a month ago, right? Right? Because central banks are reporting with a lag what the M2 is, and global money center banks are reporting with a lag. And
we know if that is true, but it probably is true. And if it was the only cause, will you not see the other way? The delay should be the other way around, right?
No, markets hate uncertainty, and then they react to last month's figures. I mean, we just saw this in the trading today. That's what happened. The Fed made some statements, right? That's why the market went up. The Fed said lower growth, higher inflation in the short run. Immediate out term is stagflation. The market responded positively because the other thing they said is they put out their dot plots with their interest rate projections for 1 and 2 years, substantially lower, right? The market for Bitcoin likes lower interest rates. The market for gold likes lower rates. Market for stocks likes lower interest rates. There was a big response to what was announced, right? And so the market does respond to the larger announcements.
Yes.
It does front run structural changes and trends and so forth, but I think, you don't know what the unemployment figures are until they're released, and sometimes they're a surprise.
Yeah. And so you're saying the liquidity that is reported today is actually the liquidity of several months ago, right? This is what you're saying.
Wow, I think a month.
But the market,
I don't know.
if that was the case, the market will have already reacted, right?
No. The market's trying to.
There is something that
the market doesn't know what the liquidity was. The market doesn't know what the liquidity is. The market only knows what the liquidity is at the micro level. It knows the micro liquidity on the Bitcoin exchanges. It knows the micro liquidity in the U.S. Treasury auction.
I see what you're saying. You're saying that is more like a sentiment kind of thing, right? But
this is a global liquidity measure. It's supposed to measure all liquidity sources.
Right.
The market
my way of thinking was that some of this liquidity finds Bitcoin, right? Is transferred to Bitcoin.
No,
And
no. Bitcoin's
okay,
small. There's this huge sea of capital. The
okay,
huge sea of capital responds to what it thinks interest rates are, what it thinks liquidity are. And it says, oh, I
okay,
need gold, I need
all
Bitcoin.
right,
And we've
okay,
seen
okay.
that gold has been leading Bitcoin recently, right? Yeah.
Okay. Yeah. So it's a sentiment thing, right? So now people, the news say, oh, the liquidity is going up. So, okay, maybe, we need to buy some Bitcoin, right?
Yeah.
Okay. I get it. I get it. Now that makes sense. Now that will explain why there is this kind of delay. Now, no, I don't know, 2 months, but it's kind of reasonable, right? That it takes time to collect the information. Of the information is transferred within that time frame, right, of a couple of months. It kind of makes sense because otherwise it's a mysterious thing. Why should be a delay, right? And if and this kind of how the information travels, because probably there are still some practices. No, it's not everything is really digitized. This information about much more is it's kind of a reporting like the PMI, right? The PMI takes
Right.
time to send
Right.
the questionnaires to the managers. Then you have to collect it, you have to calculate it. This is why it's reported once a month. So there is always a delay of at least a month, right? Because it's what people claim their sentiment was a month ago. But maybe with liquidity, whatever procedure, I'm going to research it to collect that information. And when you're saying when these news influence the market, not directly, but indirectly. And it's still amazing there is this very strong correlation between the two, right?
Right.
Even if,
Right.
I see it's good that to have more than one mind thinking about stuff because I will have wondered about
Yeah.
this for a long time. So
It,
yeah, I
it,
think you're right.
it would be interesting to separate the power law core price pairs,
Yeah.
or right, separate the power law core and the bubble zone,
Yeah, and see
and
how correlated.
see how it works in each of those too.
Very good. I will do that for next time for
Yeah.
sure. Yeah, fantastic. Yeah, this is I don't have all the work you did. I was a little bit slower than you, but yeah, this is my contribution for the week. I think but I will continue this line of research because I think it's very fascinating. Okay, do we want to look at questions? We have a few questions. Let's look at the question and look at what happened. Time is wrong. Yeah, sorry guys. We decided to do it at 8. Hopefully it's not too late for people, mostly because in Thailand they don't have daylight saving, and is better for Stephen. So it's okay, but next time I will announce it at the correct time. Yeah, sorry.
Well,
Apologies.
if the audience wants to make it an hour earlier, I don't know if you could want to poll.
Yeah, I can make a poll. Yeah, I can make a poll. What
and
is the
I
best
could
time?
accommodate that. So
Perfect.
yeah.
Okay. Okay. Let's look at this question. Yep. No, this is. I don't think this is a good.
I'm not touching that one.
No, we are not touching this. Sandworm. So what? Explain me the. I don't know what a sandworm is myself. I think I was trying to follow, but
It's the Dune movie. It's the Dune movie, right?
Oh, okay.
Yeah.
I never got to read Dune. Is it a good book? Is one of
Oh
these.
man, I read it, when I was young, like
Yeah.
college age, and I've read not only the trilogy but one or two of the others. You definitely should see the movies.
Okay.
The
I
book,
will try.
there's actually an earlier one which is not too bad, and then the two are great. The Denis Villeneuve movies. So the sandworm, for people, the very few people like Giovanni who don't know, is this creature that lives on Arrakis, the desert planet, and the freemen ride this thing, and Paul Atreides, Modip, learns how to ride the sandworm. And the sandworm is this big, powerful thing, right, that moves along and is also the source of the spice, the most valuable commodity in the universe. And we know the most valuable commodity in the solar system is now Bitcoin. So there's the analogy. And it's obviously got a lot of power, a lot of energy behind it, and a little bit difficult to ride because it's volatile. Paul learns how to ride it. He jumps on board, and he does that at a certain time when it's already moving. Well, that's what Saylor did. He jumped on, and he put his hooks in, and that was August 11th, 2020. And he's been riding that thing ever since, buying whatever the price is, So that's the sandworm analogy.
Thank you. And by the way, guys, if you put stuff like this about a 12-word recovery phrase, I'm going to block you. I just block you. It's not fun. Okay. I don't see precise question. A lot of, mostly no question, but comments.
Yeah, no, that's a good comment. They were unexpected for me too. I think what happened there was that when you throw master in, you add a lot more volatility into the mix, and then it kind of compensated by getting very safe and running to gold is what seems to happen. And these are very complex multidimensional spaces that you can't even imagine. So you're trying to search through them. Maybe the simpler way to break down is think about your portfolio in terms of Bitcoin versus everything else. And then within the everything else, think about how much stocks or how much gold or something. Master is part of your Bitcoin portfolio, right? So you want to just think about the Bitcoin master 2-asset kind of allocation. When I've done Kelly analysis, you don't want to go above 20 to 30% on MicroStrategy. Yeah. I know there are people out there that
all
MicroStrategy. Not for me, but I certainly hold it.
My friend Gladiator is like, I bought I don't know what he said, the $10 of Bitcoin. I don't know if you know this. He's very funny. I love him. He's like a young person, and he's doing all the time memes, and he says he's all ported on MicroStrategy, and his family too. His pension. It's like he likes memes and things like that. But I like him a lot. But he got his first Bitcoin. I don't know. It was not a full Bitcoin. It was $10 worth of Bitcoin. So we can analyze that portfolio. $10 worth of Bitcoin in it with a small little fraction. And there is. We will have a show on Thursday on that, and we can talk about that. Stephen doesn't know. It's this trading system. It's a kind of a little bit of. Do you have some experience with martingales? It's a little more sophisticated. Really. Yeah. But I will actually discuss it with you sometime, because it's one of the tools that I'm using right now to trade the market. Okay, guys, and we have some compliments for you that they like your presentation, even if it's a little too technical. But my suggestion with this presentation, guys, is that it's recorded, and so watch it again and trying to understand. We, like I say, on a certain point, we're going to maybe make a spreadsheet so people can actually look at a spreadsheet and they can actually use it as a tool. Because it could be a good idea to start to use this information in a practical manner, So it's a useful thing. Anyway, okay. And then there is this. Any chance we get? I will contact him. We had him on one of our shows, not these shows, but another show with we don't do anymore. But this could be maybe a better place, because we will let him talk as much as he wants, because we like both. Actually, you told me about him, right? I asked you if you knew, and then you kind of told me you read his book, and you kind of recommended it, right? Do you remember?
Yeah, he's a global expert on liquidity.
On
It's
global
hard to find
liquidity.
somebody better.
Yeah, and I like him because
Yeah.
one time I was impressed, because I don't see a lot of these tools that we use in physics used by financial people. And again, it's not because they don't know they are there, it's mostly the way of thinking. And so one time I was impressed because it was using Granger causality. And in fact, you know what?
Right.
That makes me think I want to do a Granger causality analysis on a moving window. I'm going to use a moving window, and then I'm going to do Granger causality on global liquidity versus the price.
Yeah.
Because it's possible that sometimes the leading is different, right? And maybe that is a good way of actually deciding what
That's
is an
how he
optimal.
found his 11-week
Yeah, okay. With using
Granger.
Yeah. That could be another tool to use. So Granger causality, for the people that are listening, is a tool that it looks at. It's not really, because you cannot say that is a casual link. It's mostly, okay, what leads what, right? You can look at the data, and then you can look at different lags, and say, okay, it seems that this quantity leads this other quantity, and there are some statistical approaches to determine these. And one time I want to actually, in fact, show everybody, I want to share, because I did a lot of other studies before, so this could be a good way also showing some of the old results that I already worked on. I did a Granger causality with the on-chain parameters, like, for example, addresses and hash rate, because there is this eternal question, is hash rate leading price or the other way around? And it turns out it depends where you are in the cycle, but we can discuss that sometime, because it's an interesting study that I did. Because that is another thing that for physicists is very important, the causation links between things. Okay, guys. Thank you so much to watch this show. And we will be here next week discussing other interesting, fascinating things about Bitcoin. Thank you, everybody.
Thank you, everyone.